Republic First Bancorp, let's go through the latest 10K, which was actually 12/31/21, and then the last 10Q, which is a quarterly filing that they filed. And there's some pretty obvious signs that things really went downhill in this financial statement. So let's dive into this. And I'm going to jump to page 35 of the 10K. I just want to show you what type of assets they are holding, the bank is holding, and the yields the yields on these assets as of 12/31/21. You have investment securities and restricted stock yielding 1.72%. You have loans, receivable loans that the bank has made. Those are yielding a respectable as of 12/31/21, 4.47%. On a weighted average basis, that was 3.08%. That wasn't terrible at the end of 12/31/21. The federal funds rate at that point in time was 0.25%. The thing that really shocked a lot of these banks was when the Fed kept raising interest rates, because the end of 12/31/22, the federal funds rate was 4.5%, and at the end of 12/31/23, the federal funds rate was 5.5%. So this portfolio, if they left it as is, they're only earning 3% yield on these assets when the market, let's say the federal rate, is 5.5%. Or if you even go a year backwards, 4.5%. That's not a great situation to be in. So let's jump down to page 45. And this is identifying their available for sale securities. So available for sale securities, these you are marking to fair market value. Now, when you mark them, the unrealized gains and losses, that's what I mean when I say mark, the unrealized gains and losses related to available for sale securities don't go into the income statement. They end up in the equity section under this concept called other comprehensive income. Now, there is a statement called comprehensive income, which we will go through, but for all intents and purposes, these marks, the unrealized gains and losses, are not ending up on the income statement, but at least on the balance sheet, they are marked to fair market value. Investment securities available for sale are investments that may be sold in response to changing market and interest rate conditions and for liquidity and other purposes. So what I've noticed with some of these banks, when they needed liquidity and they were holding bonds, even U.S. Treasuries, stuff that's like very safe, when the federal funds rate jumped so quickly in 2022, it really put some of these banks that were holding a ton of U.S. Treasuries or just very safe bonds in a bad situation. When you have to sell bonds in a rising interest rate environment that is rising very quickly, you're going to be in a situation where you're selling those bonds at a loss. Equalizer, when you're selling a bond with a lower interest rate, is you reduce the principal or the face value of the bond to offset the lack of market rate interest that you're getting for that bond, because it's yielding, it's generating less interest than what the market is actually at. So if you're in a bad situation where you have your bank and you have liquidity needs and you need to offload these treasuries quickly, you're selling them at a loss. And a lot of times, with a lot of these banks, if they're selling a lot of assets all at once and they're taking losses right away, these liquidity issues become realized losses on their income statement, and it might be actually putting them in a situation where they're over leveraged and they actually cannot recover from selling these assets at a loss. And we're going to continue. Investment securities available for sale totaled $1.1 billion as of December 31st, 2021, as compared to $529 million as of December 31st, 2020. Now, that's an unfortunate situation. They doubled that portfolio in a really bad time for interest rates to rise. At December 31st, 2021, the portfolio had a net unrealized loss of $12 million compared to a net unrealized gain of $1 million at December 31st, 2020. So they're already seeing a swing of almost $13 million in unrealized losses from 2020 to 2021. And the federal funds rate at that point really hasn't really moved yet. It's going to move next year, and you'll very much see it in the 10K when we go through that in a second. How impactful that was to this bank. But right now you're seeing just a glimpse of what is to come. So let's jump down. That's available for sale. Now we have held to maturity. This is the GAAP investment type that I just hate because I do not like the idea of holding. I think all investments, this is just my opinion, all investments should be marked to fair market value because I think you're hiding losses on the bank's financials. Now, they do disclose what the fair market value is, but you actually don't mark the investment down on the financial statements. The balance sheet is reflecting a cost basis investment or the cost of the investment. Let me just read this real quick. Investment securities held to maturity are investments for which there's the intent and the ability to hold the investment to maturity. So basically, you're intending to hold this to the end of the maturity. You're not intending to sell it, and that's why you're not marking it to fair market value. That's great. Still think you should mark it to fair market value. These investments are carried at amortized cost. The held to maturity portfolio consists primarily of U.S. government agency small business investment company bonds, SBA bonds, collateralized mortgage obligations, CMOs, and mortgage-backed securities, MBSs. The fair value of securities held to maturity totaled $1.6 billion and $837 million as of December 31st, 2021 and December 31st, 2020. Another situation, they doubled their portfolio here. And we'll jump to page 47 so we're going to look at page 47 before we jump to the 10Q. This is just breaking out what is available for sale and what is held to maturity. And they're giving you the fair market value. Available for sale is marked to fair market value on the balance sheet. So the balance sheet is reflecting $1,075,366,000 available for sale investments. Held to maturity is going to reflect the cost, which is the $1,660,292,000. The fair market value at this point is $1,647,360,000. So you're already reflecting a unrealized loss in this situation. You're reflecting it here in the footnote. It is not reflected in the financials. So the balance sheet is going to reflect that $1,660,000. So let's look at the 10Q because the 10Q gets ugly. It's only 9 months. But within that 9 months, the federal funds rate, just to reemphasize, it jumped to 4.5% by the end of 12/31/22. So you have a rising interest rate environment that happened very quickly, and this is all related to how quick inflation jumped up post-COVID. All right, so this 10Q is the last 10Q I could pull off from their website. This is as of 9/30/2022. I don't see, maybe there's something else out there. This is the last one I could find that was actually filed and you could actually pull and read. I'm sure these numbers look way worse now, but as of 9/30/2022, we got some ugliness in here in a couple angles. So let's just see the balance sheet right here. This isn't even getting into the footnotes, but you can see some not so good things happening. Can't really tell by the available for sale. It's hard to say what's happening there at face value, but investment securities held to maturity. You can already tell that's not a good situation. We have a cost. Remember, held to maturity is kept at cost. You have $1,562,376,000 of held to maturity investments. But if you look in the parens right here, the parentheses, we already see the fair value is $1,267,546,000. Ooh, that's almost a $300 million loss right there in your held to maturity. Now, if you're going to hold these until the bitter end, you should be okay. But if you have to sell these things, that's not a good situation to be in. Let's jump to page 5. You're going to skip over the income statement. Page 5 is other comprehensive income. This is what we're talking about earlier. Available for sale securities are reflected, the adjustment, the fair market values reflected here. Unrealized losses and unrealized gains are going to be reflected in other comprehensive income, which is technically the equity section, but you do have this consolidated statement of comprehensive income here, which starts with net income from your income statement, and then you layer in the OCI, the other comprehensive income adjustments. And we got some ugliness here. We have a quarterly section, 3 months ended September 30th on the left-hand side, and on the right-hand side, we have 9 months ended September 30th, 2022 and 2021. And you are reflecting a $143 million unrealized loss related to available for sale securities. compared to the year before of 4,265,000 loss. You had a massive jump in unrealized losses, and this all relates to rising interest rates. They're holding investments that are yielding a much lower yield. If you remember looking at the 10K, it was about a weighted average 3%, and the Fed funds rate is creeping up to 4.5 at this point. So the equalizer there is you lower the face value of those bonds, the face value of those investments, and if you need to sell them, you're taking the loss, unfortunately. Now, here, these are not real losses. They're unrealized losses, but judging by the fact that they ended up with the federal government, they must have needed liquidity, and if they sold these unrealized losses became realized losses. All right, let's continue down. Let's continue to page 8. 8's not good. I'm not going to go in great details, but this is never what you want to see in your when you're looking at financial statements. Correction of immaterial errors in previously filed financial statements. I'm not even going to go through this, but this is just not something you want to see. Basically, they made errors in previous 10Qs, and they are reflecting what those errors were in the financial statements. These are the adjustments. They weren't immaterial errors. They were material errors. So I'm just going to skip through that, but obviously that's not a great sign. So page 29 is our ugliness. This is our available. If you remember our 10K as of 12/31/21, small loss, not that big of a deal. I mean, it's $11 million. Not something to be too happy about, but it's not the end of the world. Held to maturity, only a $13 million unrealized loss. Again, not the end of the world. Now we get down to the 10Q. Man, it is not good. Investment securities developer for sale. Cost $1.2 billion. We got a $204 million unrealized loss here. Our fair value is a little less than $1 billion. That's not good. And then you have held to maturity. This is even adjusted in the financial statements. That's why I hate held to maturity accounting. I think it should be fair market value. But the balance sheet still reflects $1,562,376,000 of held to maturity investments. But we have an unrealized loss of almost $300 million. They're really only worth $1,276,546. Sorry, $1,276,546,000. So if you had to sell them, if you had to sell these assets right now, you're looking at a $500 million loss. It's not great. So I just want to show you. So remember, 1.2 billion, 1.56 billion. Now the balance sheet's going to reflect this less than billion, but it's not going to reflect the 1,267 if we jump back up to the balance sheet. See, held to maturity, still at cost, available for sale, adjusted the fair market value. And if you just want to see the income statement, no unrealized losses are reflected here. They actually still look profitable. I don't know why this number's in here like this. That looks kind of wacky. But took the straight income statement, and you're like, man, they're pretty profitable. A little less than last year, but they're still profitable. But if you look at other comprehensive income, holy moly. And you don't even have the held to maturity unrealized loss factored in there. I don't know if that's the exact reason why they ended up with the federal government, but it's got to be part of it. All right, this is the last page. It's going in a little bit more detail. And this is a back-to-back, what it looks like. What the fair value really is. And this all relates to... Yeah, here's a little bit more detail on the available for sale and held to maturity investments that the bank is holding. Here's their footnote. They don't really... I didn't find anything that directly stated hey, we know this doesn't look good, but this is what we're doing to mitigate this risk. But here's what they put in the footnote. Unrecognized losses on securities in the investment portfolio amounted to $499.1 million with a total fair value of $2.3 billion as of September 30th, 2022, compared to unrealized losses of $36.1 million with a fair value of $2.1 billion as of December 31st, 2021. So big swing in balance sheet value of their portfolio. And they can survive this if they don't have to sell those assets. It's going to be a little bit, you're going to go through some pain just because you're not generating as much interest as you could compared to what's happening with the market. But if you have to sell any of these things to meet liquidity issues, you are in big trouble. Now, I don't know exactly what the tipping point was for Republic First Bancorp ending up with the federal government, but I'm sure what we just looked at played a factor. Now, it looks like they're going over to Fulton Bank. It's not a video on bank risk management, but I do want to show how investment accounting can affect your results and how it can hide the results as well. Because if you just look at a straight income statement and you're not paying attention to the balance sheet, you might think the bank is actually healthier than it really is. In this situation, if you read the footnotes and looked at the balance sheet, you realize you've got a little bit of a ticking time bomb with these banks and this assets, and if interest rates keep going up. Now, if interest rates were to go down, that's going to be a good situation. That would have been a good situation for them. They could have recouped some of these unrealized losses, but they're in the hands with the federal government. Look like the assets are going to Fulton Bank. And that is the end of Republic First Bancorp. Hope you learned something from this video, and I will see you in the next one. Take care and goodbye.